don't care what nobody say. This generation has it way harder than any other generation. You're competing with AI and all this other technology. And on top of that, the degree that you spent 4 years and went thousands of dollars in debt to get is not even as valuable as it used to be.
The average home in America today is going to cost you around $400,000. The average American salary does not align proportionally with that home price.
If it seems like millennials and Gen Z are just the most depressed and cynical generations, it's because we are, for a lot of valid reasons. None of us know what the hell going on. We just out here winging it, man.
If you're a young adult right now, your feed is basically a 24/7 stream of financial nihilism. Every other post is some version of "you'll never own a house," "AI is destroying jobs," and "everything is more expensive." A recent survey of Gen Z and millennials found 71% say building wealth feels less achievable for their generation, and more than half feels they were set up for financial failure from the start. So you can definitely see how a lot of young adults are coming to a brutal conclusion. If the game is rigged, why even bother playing? A growing chunk of Gen Z has quietly decided the game is unwinnable and is mentally tapping out before it even starts. But today, I want to push back and argue that although the gap is real, getting to the winning side of it is actually way more attainable than the internet wants you to believe. Now, full disclosure, I'm an optimist, but I'm also a realist.
What?
Simply put, not everybody's gonna make it, and no one is coming to save you. But if you're young and you start stacking even small amounts of compounding assets now, you can build a completely different future while everyone else is busy giving up. So if it feels like the economy is splitting in two, that's because it is. Economists call this the K-shaped economy, a world where the same system is pushing one group steadily upward while another gets dragged down. On the bottom line, you've got people who feel stuck, rent jumps faster than their pay, debt never really shrinks, and they never quite get to the point where they own anything that grows for them. When they hear the claim the economy is doing great, it doesn't mean anything to them because they don't hold any assets.
The economy is doing great. The stock market's higher now than when I came to office.
Now, on the top line, you've got people whose net worth keeps quietly climbing. Their pay might be better, but more importantly, they own stuff that's rising in value. Homes, index funds, stocks, retirement accounts, Bitcoin, equity in a business, whatever. Now, this is where I want to push back on how this story usually gets told. When the media covers this, they'll almost always frame that top line as the wealthy and keep that label very vague.
Why is there this growing divide between the rich and the poor in America?
Sometimes they'll even cut to clips of billionaires to illustrate this K-shaped economy, which creates a specific psychological effect. It makes that upper arm feel like it's completely unattainable for most people, like it's just the top 1%. But here's what the data actually shows. That top arm isn't a tiny club. The upper middle class, the group that broadly maps to that upward line, has tripled in size since 1979. About 31% of US households now sit in that tier, up from 10% in 1979, making it the single largest income group in the country. The middle class isn't just disappearing into poverty. A big chunk of it has been quietly graduating upward for decades. So yes, the middle class is shrinking, but people are moving out of it in both directions. Now, some economists draw the line at roughly the top 20% of earners, but income alone is a blunt instrument. A salary that puts you in the top 20% in rural Ohio might be solidly in the middle in Manhattan. And more importantly, income isn't actually what puts you on that top line. Where one falls in the K-shape is way less about income level and more about asset ownership. During the 2008 crash, during COVID, during every major economic disruption, the people who owned assets took a hit and bounced back. In fact, if they didn't cash out, they ended up prospering. The people who did not own assets just took the hit. You can be in the top 20% of earners and stay on the bottom arm if you spend everything you make and have poor personal financial behaviors. And you can have a solidly average income and climb onto the upper arm if you consistently put money into compounding assets over time. And if you're a young adult, you have time on your side, so the goal is to get started with investing as soon as you possibly can. Because compounding is brutally simple and brutally unfair. It showers the biggest rewards on the people who start early, not the people who work the hardest. The difference between starting in your mid-20s versus your mid-30s isn't a little bit of money. It's an extra decade of growth on every dollar you put in. Let me show you how ridiculous this gets when you start early. Say you're 22 and you manage to max out a Roth IRA at about $7,500 a year, invested into something that roughly tracks the S&P 500. Historically, that's been around 10% average annual return rate over the long term. Here's what that looks like over time. After 10 years, you've put in $75,000 and it's grown to $138,000. After 20 years, you've put in $150,000 and it's now $480,000. After 30 years, you've put in $225,000 and it's now over $1.3 million. And after 40 years, from age 22 to 62, you've contributed $300,000 total and you're sitting on roughly $3.6 million. Notice what's happening. The dollars you're putting in are the same every decade, but the growth in each 10-year block keep getting bigger. The last 10 years add way more than the first 10 because all the earlier money is compounding on itself. This is something that you will feel if you don't quit and you actually stick with investing. For me, I remember when I hit my first $100,000 in investments. It was a real grind to get there, and when I finally hit 100K, it felt great. Down the road a bit, when I hit $200,000 in investments, it dawned on me immediately that going from $100,000 to $200,000 was significantly easier and faster than going from 0 to 100K, even though my behavior and my income stayed roughly the same. That's how compounding works. This is why it's so important to build up good personal financial behavior early so you can pay all your bills, build up your savings or emergency fund, and then have money left over to invest. And here's something to think about. Let's take that 40 years of investing $7,500 and drop it down to 33 years. Removing just 7 years from that cuts all your gains in half. That's why if you're young, the sooner you start investing, the better. I'm telling you, if you're young, if you're 18, 20, 22, 24, and you start investing and you take it seriously and you commit to it, by the time you get into your mid-30s, you are going to be in such a better position than 90% of the people around you in this country. And because you're young and you have all this time for compounding to take its effect, even investing a modest amount is going to pay off way more than if you waited to invest more down the road. So if you're young and you want to actually get yourself onto that upper arm of the K, what do? First, you need an actual place to invest, so open a brokerage account. Vanguard, Fidelity, and Charles Schwab are all rock-solid brokerages that have been around forever. Robinhood also makes it extremely easy to get started, and if you use my referral link, you'll get a free stock to kick things off. Now, if you're young and just getting started, I would recommend a Roth IRA. A Roth IRA is an account that lets your investments grow tax-free. You contribute money you've already paid taxes on, and then it grows totally tax-free. When you pull it out after age 59 and a half, you don't owe any taxes on those gains. In 2026, you can contribute up to $7,500 per year if you're under 50, as long as your income is under a certain threshold. I can't stress enough that maxing out a Roth IRA every year is one of the best things you can do when you're young. And if it makes you feel better, you can always withdraw your contributions, the money you put in, at any time tax and penalty free, even before retirement. It's the earnings that have stricter rules. Still, the goal is to avoid doing that. Now, for money you want to keep more accessible once you invest it, I recommend a regular taxable brokerage account. This is just a standard investment account, no special tax advantages, but you can put in as much as you want and take money out whenever you want. I really don't like the boomer advice that you need to live like a goddamn monk until you're 65 and then suddenly you can enjoy life once you're retired. A regular brokerage account lets you invest for the long term and still have the option to use that money for things before retirement when you need it. A down payment, starting a business, taking a vacation, fixing a furnace, moving cities, buying Pokemon cards, whatever. Once you've built up your emergency fund and however many months of living expenses in a savings account, you probably want your excess money to earn more than it would in just a high-yield savings account. Now, what do you actually invest in these accounts? For most people, the answer is boring on purpose. Low-cost index fund ETFs. These are funds that just track broad chunks of the market, like the S&P 500, for instance. Think of this one as a fund that gives you a little piece of all 500 of the US's top companies. Personally, most of my holdings are in S&P 500 ETFs like VU and SPY. That's where about 80% of my investments are. I also have some QQQM, which is an index fund that tracks the NASDAQ Top 100. This is made up of the largest tech companies, and it has actually outperformed the S&P 500 recently, but historically it is more volatile. I do own some individual stocks, but only in businesses I genuinely understand, I really believe in, and am willing to hold for the long run. Long-term ownership, not short-term gambling. And here's where a lot of people go wrong. They obsess over stock picking. Please do yourself a favor and remember this. Over long periods, the majority, and many studies say 90+% of professional fund managers, people who do this full-time with research teams and huge budgets, still fail to beat simple index funds that track the market. So if your plan is to sit on your phone trying to outtrade Wall Street from your couch, you're likely setting yourself up to lose to a boring index fund anyway. A much smarter move, honestly, is to focus on increasing your income so you can invest more money into those boring, diversified, long-term index funds. Too many people spend all their energy hunting for the next lottery ticket stock or high-risk crypto play when the real power move is figure out how to earn more money and shovel that extra money into low-cost, long-term compounding assets. And just a caveat, when I say avoid high-risk crypto play, I'm not talking about holding Bitcoin. I like Bitcoin as a small part of my portfolio. I do encourage people to learn about it and get some if they believe in it. But these altcoins and all this other crazy shit, just know you're gambling with that. Things like the S&P 500 ETFs are boring, but that's exactly why they work. Historically, the S&P 500 has delivered around 10 or 11% average annual return rate over the last century. It's about 15% over the last decade, if I'm not mistaken, despite plenty of crashes and scary headlines along the way. Meanwhile, a lot of Gen Z is getting pulled into sports betting, prediction markets, meme coins, and ultra speculative altcoins. There's a reason patience is strongly linked with better long-term outcomes in life and in investing.
But the market is at all-time highs.
One of the most common sentiments you'll see online is, the market is insanely expensive right now, valuations are high, this is the worst possible time for young people to invest, you're buying at the top, you should wait for a crash. But here's what the data actually shows. On average, the S&P 500 hits new all-time highs around 18 days per year. In strong years, it can hit dozens of new highs. In 2024, for example, it logged around 50 record closes by early November alone. Over multiple decades, that adds up to hundreds of all-time highs, not because the market is rigged, but because the economy grows over time and corporate profits tend to rise with it. If you refuse to invest whenever prices are near a high, you end up sitting on the sidelines for huge chunks of your life. Trying to perfectly time crashes and recoveries is a game almost nobody wins. Staying invested and letting time do the heavy lifting is what historically builds wealth. Which brings us to avoid doom scrolling yourself into paralysis. If your entire view of money, markets, and the future is shaped by viral doom posts, it's gonna feel hopeless. The irony is that while social media is telling you it's all over, millions of people are quietly doing the boring, compounding thing and steadily moving up that K. The wealth gap is real, the system isn't fair, the government isn't gonna fix anything, and not everybody's gonna make it. You gotta get on the upper arm of that K, but it's not as out of reach as you think. Earn, save, invest, compound. Stick with it long enough, and there's a moment where your investments start growing faster than the new money you're putting in. That's the magic of compounding, and once you get there, you'll be very glad you didn't sit on the sidelines waiting for the perfect moment. Thanks so much for watching. I hope this video was helpful to you, and if it was, check out this video about what I think is the best credit card on the market.